Welcome back, everyone, to Vox Markets. My name is Paul Hurl. I'm delighted again to be able to speak to two titans of the investment world, namely Martin Gilbert, chairman at Assetco and Revolut, and founder and CEO of Longview Economics, Chris Watling. So welcome, gents.
Well, it's lovely to be here. Thanks for having us.
Yeah, thank you.
Now, Martin, I think we could start with you. Given the sort of the ongoing problems in Ukraine, likewise with the sort of the continual lockdowns in China, and then we've obviously got the central banks tightening and with sort of like red hot inflation. What's your sort of broad view of the sort of the economy going forward, and just your feel whether we're going to have a mild or a severe recession?
Well, look, I'll let Chris wade in. I mean, he's much more expert than me in this, but I think I'm not convinced there's much we can do with to try and curb inflation here because the economy is so strong. But it's largely caused, as we know, by commodity prices, supply chain issues, etc. But obviously, with the economy being so strong, I think they're going to have to probably look at trying to slow the growth by putting interest rates up probably slightly more than consensus at the moment. But look, Chris, you weighed in. You're much more expert than me in the field of economics.
Well, that's very kind of you to say so. I certainly don't have your experience, but I would say. Actually, I think the debate's shifting. The markets in the last few weeks have been fascinating. 3 weeks ago, it was all about inflation. In the last 2 weeks, it's all become about growth. The whole debate has just swiveled literally on a dime. And I have to say, I think if you look at the buildup of inventories, I call it the Walmart effect. I think this is the most fascinating. To be honest, in many ways, we're seeing Economics 101 play out in front of our eyes in all sorts of ways, inflation, inventories. But the Walmart effect is well at work. And you'll have seen Walmart and Target a few weeks ago talk about inventories being too high. And as I say to everyone, you can imagine last year, everyone's buying goods. You get to the end of the year, you're the Walmart purchasing guy, and you think, well, we probably don't need quite that much this year. I might reduce by 10%. When in reality, you should go half. Everyone's bought their garden shed, everyone's bought their spade, and the reality is there's massive overordering and inventories have never been higher. So we're going to get this, I think they call it the bullwhip effect, with inventories having to be run down. That's the first thing going on in this global economy, and we're seeing that play out now.
So that should be deflationary, shouldn't it, Chris?
That will bring back some disinflation or even deflation, certainly in the goods sector, which I think is going to be fascinating. There's some interesting stories over the weekend from Chinese companies saying orders they're just not here. Shanghai container rates are down aggressively. So that debate's changing. And then I think there's also central banks, as Martin alluded to, are still putting up rates. And they're probably going to go too far. So they'll push us, every recession in the last 50 years has been caused by central banks over tightening. So I think we're gonna run into that next year. So it's a very interesting debate. Today, we're seeing a slowdown on the back of inventories. Next year, we could see a proper recession dynamic coming out of the States. So it's a fascinating macro world. As I say, all those debates are playing out right in front of our eyes. It's Economics 101 at work.
And Chris, what's been priced into the markets currently in terms of them? If you look at the bond curve out in the US, it's pretty flat. In fact, I think it inverted between the 5 and the 10 yield, 10-year last week. And likewise in the UK, it's sort of like not quite as flat, but it's suggesting a sort of like it's sort of suggesting a mild recession. And then we've got sort of the equity markets that is ignoring what the analysts are saying and already sort of taken prices down. What's your sort of like objective or sort of like even subjective view of what's priced into markets, regardless of what's overtly stated by analysts?
Yeah, I mean, again, you've got to start unraveling stuff, and it's different markets have different messages. I would say the bond market, the curve actually inverted last week, particularly at the 10-2 year. That's the best place to look at it. The other ways give you a lot of false signals and a lot of noise. 10s, 2's the cleanest one, so that's got an inversion. Again, it inverted briefly in April and then re-steepened. But so we saw that. So that's bond markets starting to tell you about a recession next year. The equity market, I think, basically repriced on rising bond yields over first 6 months of this year. So undermined growth stocks, we saw that was the biggest underperformance area in the first 6 months of the year. And I think the equity market hasn't got it. If you look at consensus earnings, we're looking at 8% growth in 2023 on the back of 9-10% in the US this year. So that's not priced in either. Albeit
the multiples come down, so actually your strategists and your fund managers are just ignoring it anyway. They're already putting a haircut on that $250 per share.
Well, no, I wouldn't argue that. I would actually argue the re-rating is on the back of normalization of monetary policy from emergency to normal. Right. And we had a taper tantrum in TIPS yields, a bit like we had in 2013, but a bit more accentuated and a bit stronger. So there's chapters to every bear market, and there's chapters to the way markets move. So we've had chapter number one, taper tantrum, re-rating of TIPS yields. And now I think actually we're due a relief rally now, personally, I think, for a bunch of months or a number of weeks. And then we'll get another big chapter in the downside when we start thinking about 2023's economic outlook.
So you're pretty cautious then in that case at the moment?
So I'm good for a few months, I think. I think markets can do well short term, but I'm increasingly nervous. Quite a lot of our recession models started to give a signal last week. So I'm quite nervous about 2023 and as we get into Q4 this year.
Okay, well, let's turn on sort of a bit more on the optimism side. Now, Martin, I need your expertise in all things sort of Russia and emerging markets and China. Now, two big positive catalysts could be, so if we do ever get a ceasefire, and obviously we don't know what Putin would ever sort of decide, but did get a ceasefire, or alternatively, China decided or developed its own local vaccines that could handle Omicron and get it into people's arms. What's your sort of like view on both of those two big positive catalysts? Because if we get a resolution to either of those, that will significantly reduce the inflationary pressures and also the need for central bankers to put up interest rates.
No, you're absolutely right. I mean, I come from the school of thought that I'm not sure putting up interest rates is going to really have a huge effect, apart from to tip, of course, as Chris said, the economy into a mild recession and hopefully curb a bit of wage inflation. But I'm not positive on either of those two things occurring. I'm probably more positive on China getting a vaccine rather than Ukraine, Russia sort of being resolved anytime in the short term. But going back to Chris's point on destocking and of inventories, I mean, we're already seeing that in some of the commodity prices are coming off the top. The ones that aren't are really coal and gas, of course, which are of course a necessary requirement for a lot of these emerging markets to produce electricity. So those two are causing, obviously, inflationary aspects to the economy. But I'm not positive on Russia, Ukraine resolving it anytime soon.
And what just on China? I know you were you're pretty positive on ASEAN before. I don't know whether you were positive on China. What's your sort of view on China? Be given, is it I've heard a lot of sort of investment professionals saying it's a sort of like a no touch at the moment, given the regulatory crackdowns and that zero sort of COVID policy.
Yeah, I've always had this adage that in China, you need to be as close to the government as possible. And India, you need to be as far away from the government as possible. So it's a very difficult country to make money. But it is possible to make money if you get your stock selection right, obviously. But you're right, as I saw further fines for Tencent and Alibaba. These sort of things do spook international investors. And I do see Kuala Lumpur, I think, is the only market up today. So it's difficult. Often I think you can probably get a lot of the advantages of China in India with perhaps better governance. But governance will improve in China. And it's obviously a phenomenal growth, a phenomenal part of the world to invest if you can get it right.
Yeah. What about the currency markets, Chris, in terms of sort of like, sterling versus dollar, and the euro seems to be going below, the actual dollar on economic concerns. What's your sort of view for those currency fluctuations?
Yeah, I mean, the euro, the chat in markets has been about it heading towards parity. And the challenge for the euro is really solving this fragmentation issue in Eurozone peripheral bond spreads. We've seen Italian bond spreads wide out dramatically over bunds. And the ECB's come out and said they're going to have a plan, but we don't know what the plan is yet. And the Bundesbank's looking disruptive in the background in terms of not wanting to allow or wanting to challenge any plan the ECB comes up with. So we could be back as we were, in the Euro crisis, back in those German constitutional courts. And also, I just don't see how the ECB is going to easily contain those spreads without printing money, which would be contrary, obviously, to what they're trying to do in terms of fighting inflation. So there's been some chat about maybe selling bunds, buying Italians, and closing the spreads, but that would be unconstitutional, I think, relative to the ECB's how it was set up and so on. So that would be open to a challenge in those constitutional courts. So to the euro, I think you'd be a brave man to buy it. Let's put it that way. In terms of sterling, now that is getting interesting. 119, 120 against the dollar is a level we've hit a bunch of times. I mean, on the Brexit vote, we briefly went through that and then bounced straight back. We were at 120, I think, a couple of years before that. And really, it's quite a good support level. And we're going to see some resolution to the political uncertainty. We may actually have a leader in this country with a bit more of an economic plan, which might give some confidence to.
Well, it'll be good for the pub makers anyway.
Be good for the pub makers, absolutely. I think it'd be good. I mean, anyway, but so yeah, so I think sterling's quite interesting here. It's a very cheap currency, and actually, it's got the stock market that's got quite a lot of good stuff in it in terms of commodity super cycles and all that kind of stuff.
And just in terms of that anti-fragmentation, which does seem to be the nub of the issue in Europe, with the bond yields sort of widening in Italy and Greece over bunds, etc. You mentioned sort of like potentially selling bunds to buy BTBs or where in Italy, etc. But would they go to sort of like quantitative easing or even sort of heaven forbid sort of euro bonds?
Well, how can you go to quantitative easing when you're trying to fight inflation? I mean, it's just totally contradictory. And the Bundesbank and probably the Dutch as well, the guys who are into sound money would be outraged. So it would be challenged. I find it hard to believe they'll get that through unless there really is a proper crisis. This is what the Bundesbank president was saying the other day. How do you define a crisis in spreads? What level should the spreads be at? And there's a time when you're in a crisis, sure. But at the moment, you wouldn't necessarily say that about the spreads. It looks troubling. It's worrying. But it's not necessarily a clear crisis yet. So I don't know. I'd be amazed if they printed money without the whole thing looking like we're back in 2012, Italy blowing up type territory.
Now, Martin, just in terms of, one of the big issues has been, with inflation has been the oil price, et cetera, and associated with the gas, et cetera. Have we seen the peak in the oil price at sort of $120, $125 per barrel, or is that could be the risk is still we're going to go back?
Well, I think I don't think we're going to go back to 40 to 60. I mean, that's for sure. I think it'll hover around 100 for some time, mainly because there's been no oil exploration in the world for the last 5 years. So obviously I have a house in Aberdeen, and the housing market in Aberdeen has taken off in terms of lettings again. Wow. So we're seeing a huge amount of activity because, of course, it's a great center for oil. As you know, one of the busiest helicopter airports in the world, but also it's a renewables center. So there's a double sort of benefit to Aberdeen this time, and so we're seeing real activity in the sector. Now, it will take some time, obviously, to turn on oil in say the North Sea being an example, but renewables is a massive area now in the North Sea and obviously the Celtic Sea. And it's all floating offshore wind, which is, of course, a great area to be, because you don't have these infrastructure costs of trying to anchor them to the ground or trying to fix them to the ground. You're actually floating them and just anchoring the floating turbines. So massive area going forward.
And what about just on that, touching on that renewables? I know you've got sort of like still good sort of bird's eye view into all things sort of metals and stuff like that. Which ones are going to sort of really benefit? I know it's obviously copper with the wiring, and you've got manganese with the galvanization, and lithium with the batteries. What else is the sort of like cobalt? I don't know.
Cobalt's the other big one, and of course, I'm fortunate, as you say, to be on the board of Glencore, which is probably one of the best plays in what I would term future metals, but at the moment benefiting from the high coal price. And interestingly, the mood has changed amongst investors on divesting these sort of fossil fuels. I think that we're seeing definitely a view that companies like Glencore are the best owners of these fossil fuels and sort of running them off long term. What a lot of investors are reluctant to see is a sort of rerun of the Anglo spin-off of the coal division, and then the coal division sort of going up 700-800% in price because it's going to start developing again. So and they're worried about it, these sort of legacy fossil fuel assets falling into the wrong hands, etc. So it's a very, very interesting world at the moment. There's been a sort of change since COP24. So COP26, I can never remember.
26 it was, yeah, that's right.
Thank you. And then we go to COP27 shortly. So it's going to be, it's a very, very interesting world, a more pragmatic world, probably.
And Chris, just moving on to sort of like, you've obviously a view on, you're fairly cautious on equities, but if you're cautious on equities because you think there's going to be a recession, you must be reasonably bullish on fixed income then, I guess, if you think there's going to be, albeit, on the other side of that coin, you do have, sort of QT, don't you? Quantitative tightening, which is going to naturally have the governments, selling literally trillions of dollars, certainly the US government over the next couple of years. So how does that sort of play forward on your sort of like your best assets or your best areas of the fixed income market?
Well, I think actually buying government bonds is a brilliant idea. I mean, I think there's about 6 reasons to buy them and 1 reason not to. And ironically, you mentioned quantitative tightening with the central bank selling bonds. The market always seems to get this topsy-turvy to me. I mean, it's not about who's selling and buying. It's about, there's 2 ways of running monetary policy. You either change the price of liquidity, which is the interest rate, or you change the amount of liquidity in the market. And if you sell government bonds into the market, you're reducing the amount of liquidity. And actually, bonds tend to rally on that and the yield falls. That's certainly the experience of 2018. That's the experience of prior times when we finished QE. So, that's one reason to be bullish bonds. Of course, if like me, you think a recession's likely, you're bullish bonds. If it's an ongoing equity bear market, you're bullish bonds. I mean, it's a long old list. And the only reason not to be bullish bonds is if you think inflation is definitely staying sticky and staying at high levels, which I don't. So, I think fixed income, long duration, 10, 30 years, all of that stuff in the States, it all goes together basically. So if the US rallies, everything rallies. I think that's a nice place to be, and that will play into sectors at some stage as well. But we like government bonds. I think they're quite interesting.
And just on that thesis of you think that with the inflation staying sticky for longer, I mean, I did look at the OECD expectations for next year, 2023, and they still have the US at 3.5%, so well above their 2% sort of like, target. But the UK, I think they've got about 6.5%, for next year. Yeah. So that's suggesting that actually the OECD, who may be hyper cautious, do think that inflation is gonna stick around. So what's the disconnect between what you reckon and what the OECD reckons?
What the OECD reckons, yeah, the august forecasting body. What do they? They're obviously, I mean, I'm an economist, so I can't be rude about economists. I think they're a great bunch, but they all tend to be backward looking, and really what you want to look for is what's changing. So I like to say to people, this is the best example of monetary inflation we've ever had, certainly in my lifetime, but really probably even the 70s wasn't a clean example of monetary inflation, because you had a lot of price controls and a lot of things going on in the 1970s that we don't have today, really. If you look back over 150 years, whenever you get spikes in M2 money supply in the States, you get a spike in CPI, and when M2 comes off, CPI comes off. And of course, M2 is actually come off. It was 28% year on year in February last year. It's now running at 6 and change. So money supply growth is now below nominal GDP growth, which is a monetarist way of saying actually money's too tight, and inflation should come down. So I think the risk here is we'll be surprised by how quickly it comes down. And I accept all the supply shocks. I understand all that. But, in the old days, we used to say when oil price spiked, that was deflationary because there wasn't enough money around. These days, we say it's inflationary because there's a lot of money around. Well, if that money pool's shrinking, then I think those supply shocks will become deflationary once again, which is really another way of saying there's a cost of living crisis. It's the same thing.
And just sort of probing that a touch, if inflation is softer and it comes off, then presumably there'll be less tightening by central banks, which is why you've got your thesis on fixed income. But equally, it will be good for equities, wouldn't it? Sort of long-term, well, certainly long-term growers, secular growers.
It would be if they hadn't over-tightened. But the problem is the central banks are backward-looking. Basically the market moves ahead of the central banks. So what's interesting about the last few weeks is the markets has started pricing in rate cuts in the States in 2023 and 24. So hikes all the way through this year to a peak in March next year, and then cuts. But the Fed is, still, Jerome Powell 2 weeks ago said, we don't care about the inversion of the yield curve. We want to see the whites of the eyes of inflation down dramatically, and then we'll start easing off. So, in other words, they will have tightened too much, right, and it'll be too late to right the ship. I think that's what the models are telling us. They've gone too far, and the recession is increasingly looking like it's baked in for 2023.
Right. Okay. Now, Martin, given that sort of background, and obviously we're entering the Q2 earnings season with the banks, what's your sort of view currently on the sort of the mainstream banks, and also a bit on the sort of the fund managers, and also anything in fintech? What's your sort of all on the financials? Because if we go through a tough recession, that's going to impact the credit cycle, I'm guessing.
I think the banks are in a good position, the mainstream banks, because any interest rate rise really drops straight to the bottom line for them. And I was speaking to one of the big banks. I was speaking to HSBC, and just the rise in the deposits at the Bank of England that they have is meaningful. So I'm not convinced, but I think inflation is probably going to come down faster than we think because of supply chain destocking and commodity prices coming down. So I don't really see a big bad debt problem with the banks, and they are very, very well capitalized now. So banks, I think the big banks are great. Clearly, the Revoluts of this world are doing very well because travel has started again. As you know, the original concept of Revolut, although it's diversified away hugely from that over the past sort of 3 or 4 years, was based on interchange. And I was recently in Ireland last week, and 2 out of 3 people in Ireland have a Revolut card. I mean, we're speaking of massive penetration in certain markets. So I think the fintechs are going to do well as long as they've raised their money. But there is a credit crunch definitely in fundraisings, and we saw that in Klarna, as you know, coming down from whatever it was. I can't remember the exact numbers, 40 to 8 or something like that. These are massive falls in some fintech valuations. So it's the haves and have-nots there. And I mean, if inflation is less than we think, although I do take Chris's point that the central banks are backward-looking, fund managers should do pretty well. But certainly the big banks are looking good at the moment with interest rate rises. I mean, I'm more negative on bonds than Chris. You know, I'm old enough to have started my career when interest rates were 18%. So we've been involved in a 40-year bull market. And I think there's a bit of a bear market for bonds over the next couple of years to go back up to what I would term a more normal rate.
Yeah, I wouldn't disagree with that. I think the structural trend is yields are up, but I just think we've got a counter trend move that may last 6-9 months.
Yeah. No, I agree.
So Chris, just on that one, just the fixed income, just because I mean, Martin raised an excellent point there. I'm an equity guy as well, okay, and it would only interest me once you started getting positive real yields. Yeah, and I think the break-even inflation in the States is about 2.5%. Break-evens in the UK about 3.5%, but that's the RPI measure, etc. So when are we going to get positive real yields? They're still negative, aren't they?
Well, the US 10-year TIPS yields are positive, so they're trading about 0.5% up from minus a half at the start of the year, minus 0.75. So they are positive. In the UK, actually, I haven't checked them for a while, so I'm not entirely sure. But I guess given implied inflation's where it is, they must be negative, of course, so quite meaningfully negative. Yeah, I mean, don't misunderstand me. I think it's structurally speaking, if you're looking on a multi-year view, the world is completely different to what it was for 10 years post-financial crisis. That was all about shrinking balance sheets, households paying down debt, commercial banks getting themselves in order and their houses in order. We've done all that. We're much more in a normal macro world in a sense, with a sort of war loaded on top and a huge pandemic stimulus that the authorities are trying to deal with. But I think the general thrust of the next few years is inflation's a little bit more than it was, and it's kind of back to normal. So, and I think real bond yields will get back to normal as well as part of that, as central banks have to fight all this and normalize policy. So, yeah, we're back in a more normal world. That's the good thing. And I would completely agree with Martin on the commercial banks. They're recapitalized. They look great. I don't think there's a big credit downturn coming. This is not the GFC. This is more like 2002. There's a lot of excess in financial markets in the States in particular, and it's going to be expunged. A bunch of it's already been expunged, and a bunch more has got to be expunged. Private equity, you touched on it, Martin, with all those startups. I mean, and the Sequoia Capital memo, the famous memo, now, guys, you have to make profit, forget the running the business for revenues. And you'll have seen there's all those charts on Twitter of tech startup layoffs just taking off in the last couple of months. So that's all different. We've got to reprice the whole private equity space. That's going to have repercussions somewhere. But what we're talking about now is not commercial banks getting badly beaten up on the credit cycle. We're talking about a normalization of frothiness after several years of uber excessive monetary policy, really. I mean, 15 years of it, really, accentuated by the last 2 years.
And they definitely benefit from higher interest rates. I mean, it transforms them.
Yeah, that was a great, yeah.
Yeah, it transforms Revolut because Revolut sits with $10 billion euros every night, some of it on negative interest rates. I mean, it's or zero or negative. So you can see what it does to these P&Ls.
Yeah, and all the NIMs have been expanding. Martin, you'd know better than I do, but they've all been expanding and Paul, you probably follow this stuff as well. They've been expanding as rates start to normalize. So that's all good for the banks.
Okay. And then this is for both of you, I guess. Is there anything out there of sort of counterparty risk? I mean, you had Credit Suisse raising money at 9.75%. That was a cocoa bond, etc. But even so, that was a bit obviously raised eyebrows. And you've got sort of potential contagion in terms of, I don't know, crypto or even, sort of margin debt and these sort of stuff, some of the hedge funds. Is there anything to worry about out there? I mean, this is for both of you as much. And Martin, do you want to start with that one? Is there anything you've seen at all?
Not obvious. I mean, it's not like just pre the financial crisis where we had these highly leveraged funds. We had a lot of the counterparty risk. We had credit default swaps, all with one insurance company in the world. We had CDOs. And I don't see that so much. Maybe some private equity valuations are probably, but again, it's not a big retail area that it's a lot of pension funds. I think we saw CalPERS, was it last week, selling all their their private equity holdings at a discount. So in this stage in the cycle, there can be a bit of, because we're not going to see the exits, there could be a bit of cash flow problems there, but nothing. I don't see it as being as serious as pre the financial crisis, where it was quite obvious we were going to see CDOs and CDSs going wrong.
What about you, Chris?
I broadly agree with that. I think absolutely. If you look at the big picture macro indicators, debt has gone down generally in most parts of the Western world. So you might worry more about China or places like that where they've had a lot of buildup of debt, or even places like Australia, perhaps. But generally, Europe, UK, US, top level debt's down. There are pockets of frothiness, absolutely. I slightly worry about crypto. I think there's some blowback there. I was very surprised to be at a conference not many months ago and listening to I think it was a Fidelity survey where they said over 50% of the institutions they survey were now seriously engaged in crypto. And you know, crypto market cap's gone from 3 trillion to 1 trillion. And we know it's a lot of it's Ponzi-like in that people are making income when there's no income earned. That's basically a definition of a Ponzi scheme. So there are some question marks there, but I would agree with Martin. There's nothing systemic. It doesn't look systemic. There are issues, definitely, but it doesn't. I mean, I suppose Italian bond spreads is something you really would worry about. But hopefully a plan. I don't know what it is, but hopefully they'll come up with a plan to deal with that. But yeah, I mean, generally, this is not the GFC, I don't think.
Okay, and then just in terms of equities, Chris, I know you're obviously relatively positive on short-term bonds and cautious on equities, but is there anywhere in the equity world that you're sort of like more attracted to?
Yeah, I mean, I think we've got a tactical rally brewing, by which I mean a few months of upside. If you think of the long bear markets, you get 3, 4, 5 month rallies when everyone is like, oh, okay, everything's fine again. And I suspect we may be building to one of those. And if you look at some of the tech stocks, they look actually from a technical point of view, absolutely terrific. Look at someone like Amazon, it keeps finding support over the last 2 months, and it looks like it's moving up to the upside. Some of the other mega cap tech stocks are the same. You look at corporate insider buying on tech, it's really, really high. And those guys generally get it right. You know, when Martin buys his stock, you know you should be buying it. When he's selling it, you should be selling it. And it's the same with the tech executives. They've all been buying recently. So I think that's a good sign. And actually, the last thing I'd say on tech is actually we've had the biggest derating of tech in the US in 6 months, really sort of one of the 4 biggest deratings in 40 years. So that says to me at least a relief rally. If not, you know, if you're an optimist, you go for something more. But the Nasdaq's derated by just short of 35% this year. And really, that's what it did in the 1987 crash. That's what it did sort of in a couple of chapters in 2000 to 02 and in the pandemic, et cetera, et cetera. So I like tech basically for a flutter. Call it a flutter if you like.
Right. Okay. Is there anything on a fundamentals basis rather than a sort of technical basis you quite like, or is it all sort of like you're just very cautious? You want to sort of like keep your powder dry?
Well, I mean, the reality is, if we're going to if you're going to look at the market now and you're worried about a 2-year view or an 18-month view or whatever, you're worried about recession next year, you want to go defensive. But actually, the defensives have had a really good run for 12 months. Staples is a very expensive sector now, so's utilities, etc. So I would be tactical in this market. And then looking to flip that, if I'm right about the tactical rally, looking to flip it in a few months' time, go more cautious or go to cash.
What about you, Martin?
Yeah, I'm probably slightly more positive. I think the tech slide, shall we say, in the big US growth stocks is probably a correction. I think they just got overpriced and momentum had driven them too high. So I think there's nothing fundamentally wrong with them. What I would say is probably I'm not taking a tactical approach. I'm sort of more of a fundamental approach, and I would look at some thematic trends probably, which are, the BPs and Shells are good value. The Rios are good as long as we don't think there's going to be a recession because they're big in iron ore. The Glencores are big in the copper and cobalts. I would say Asian small caps are good. play it through a fund. I really like UK mid and small cap. There's so much value there, and with the pound dollar rate the way it is, they're just going to get picked off one by one. So you got to choose a spread there. Or
any names at all you quite like in the small and big cap?
Yeah, no, I just like. I mean, I play it through a fund because that way you get the spread. And then property, I would go a bit thematic there. I would again, supply chain sheds are even they're blindingly obvious. I would say film studios. You can't rent a film studio for the next 4 or 5 years. If you recall, they used to be the most cyclical of businesses. I like service stations because they're going to benefit from the growth of electric vehicles, because we're all going to have to stop at service vehicles now for a cup of coffee for 20 minutes or half an hour.
Yeah, I've never thought about that. That's an interesting concept, that is. You're going to get Starbucks taking over all the service stations.
And they're all crap as well, aren't they? I mean, if the good service stations are going to do well. So I think it's more thematic, probably. I like, and we already said the big banks are going to be a good, safe place to put your money for a reasonable yield. But a bit like you, I don't like it when good companies' bonds yield less than the dividend they're paying. So I think there's a sort of reversal to come there. So I'd rather own the companies than the bonds at the moment. So just a few thematic ideas.
Yeah, and Chris, just on the small and mid cap, say in the UK, what's your sort of view? Because they do seem to have entered a bear market before the actual mega caps did, and if you look at the sort of repeat of what happened at the growth at the financial crisis of 2008, 2009, they came out. It was the same thing, but they came out the actual bear market faster than the big cap boys.
Yeah, and that's perfectly plausible once again, I think. I mean, it's just a question of when they come out. But yeah, I mean, they've derated. I think a lot of that is high inflation affecting the economy, squeezing real income. So if we're right on inflation coming off, then that could actually work quite well for the mid and small caps. I mean, what I would say is thematically, I agree with quite a lot of what Martin said. Absolutely. I think some great themes in there. I just think there's, for me, that, you want to get them when they're a bit beaten up. And I just wonder if, I think, for example, oil service companies, absolutely. But I think the oil price is coming off to 80 or 75 or something like that on this recession risk. I mean, you put soft landings and recessions in the numbers, it changes dramatically. So I love that theme. I love the commodity. I think we're in a commodity super cycle, but again, it comes in chapters. So you got to pick your timing. Actually, interestingly, iron ore is perhaps a better way to do it. If China's going to keep stimulating, that's perhaps one commodity that does have a flutter here to the upside. So maybe that's a better timing on that one. But yeah, I mean, UK economy, I'm hopeful, but maybe I've just got home bias.
I think the other thing, Paul, is there is a technical situation in UK mid and small cap. The fund managers are seeing quite a lot of outflows out of the funds at the moment. When that happens, they need to sell. And the markets are so thin that so illiquid in a lot of these things, it just drives the share prices down.
Yeah. I'd point to investors, have a look at the valuations, because I think the S&P, I mean, it's come off from about 20 times to about 16 times totally. You've got the UK, they've got the small and mid and the small and mid caps on about 13 times, and then obviously you've got the big cap boys who are the oil and the commodity guys on about 11, 12 times, I think. So it's even cheaper, but there does seem to be plenty of value in the UK, even compared to sort of international.
Yeah. Certainly, if you look at the FTSE 100 relative to global equities, it's just about never been cheaper, particularly if you put it against the US. So, theme, I think, is there. Absolutely.
Yeah. And then just finally, then, I guess, is there anything out there that we need to sort of like, any risk are you watching at all with regards to the thesis? I mean, Martin, I don't know if there's anything out there that you're sort of like looking at sort of the health of the consumer or something like that, or is it really just
all about interest rates?
Fine. And what about you, Chris? Is there anything sort of out there that maybe not frontline data that is sort of like is something to watch for investors they can get their hands on?
Yeah, I mean, I wish I could be as succinct as Martin. No, I mean, the list is extremely long. I think.
Okay.
Interest rates are critical. But look, I mean, there's a proxy war being waged, in Ukraine at the moment between the West and a growing authoritarian axis between China and Russia. So we're watching that. We're watching Putin keeps turning the gas off to some countries. German electricity prices are winding people up at the moment. They've spiked aggressively. Wednesday CPI data out the States. I don't know if we'll have published by then, maybe not, but that'll be.
No, we will have done.
watched.
Yeah, it'll be the. Yeah. We will have published. Yeah.
Okay, perfect. So I mean, it's a super long list. There's a lot going on. Macro. There's so much going on in the macro space. So many different debates to watch. It just keeps it interesting.
Brilliant. Okay, well, thanks very much again, gents, for your brilliant insights into all things capital markets. And we've obviously got lots of moving parts over the next 6 months, and look forward in touching base around about Christmas.
Brilliant. Thank you. Thanks very much.